Hi, everyone. Hope you're all well. So we have the lovely Eliza with us today from CoreLogic. Now she is going to go through with us today the last quarter updates. She's going to take us through some trends within the data, and also to the end, if there is any questions at all that anyone has, please pop them in the chat box up the top, and we'll have a bit of a Q&A at the end as well. So take it away, Eliza.
Amazing. Thanks, Tanika, and thanks everyone for your time this morning. So as mentioned, I'm going to be running through the housing market update. We'll look at some of the dynamics in capital growth at the moment, as well as some of the drivers of the resilience in our housing market. Key to this is also looking at the sales and listings position, investor outlook, and we'll do a bit of on the rental market as well. To kick us off, I just wanted to share this kind of high-level view of the state of residential real estate as an asset class in Australia. I think it's always good to remember that residential real estate is a key component, not only for economic activity in Australia, but it's incredibly important to households from a wealth perspective. And over time, it's become a kind of implicit pillar of our retirement as well. So as of the end of September, CoreLogic puts the value of residential real estate at $10 trillion. This is more than the combined value of other sources of wealth like the ASX, superannuation, and the commercial real estate sector. We currently estimate the value of or the portion of household wealth held in the real estate asset is sitting at 57%. And we can see that the transaction activity is sitting at about 471,000 for the past 12 months. That's a little bit below average. Usually you'd expect to see around 480,000 sales in a year. And we'll go through some of what might be keeping a lid on that transaction volume, despite the fact that prices are rising. So to kick us off with, again, a kind of high-level overview of what the Australian property market is doing, we have this chart which shows the monthly change over time in CoreLogic's flagship measure of housing values, which is our home value index. So the home value index is measuring the entire value of the real estate asset as if it's one giant portfolio over time. So this is the month-to-month change. On this graph, we've gone back about a decade and we've put a lot of the different factors that have shaped housing market performance over time. So here more recently, we have the COVID period, which shows a very large and extended uplift in property values through unprecedented peacetime stimulus, record low interest rates, and all of the reaction from government and institutions that came with COVID. This created an upswing of about 31% in the space of around 2 years in Australia's property market. As inflationary pressures set in and the RBA started to lift the underlying cash rate, this created a short but sharp adjustment in Australian home values, which dipped 7.5% between May of 2022 and January this year. What's remarkable is that since the start of this year, there's been a further 1 percentage point uplift in the underlying cash rate. So at the start of 2023, we were sitting at 3.1. We're now at 4.1 in the cash rate. But despite that, property values have been rising. So you can see that again through the start of 2023, we've had 8 consecutive months of uplift. We put this down to factors like record levels of overseas migration, low vacancy rates in the rental market, which is starting to create more investor interest, and probably the expectation that the cash rate is very near its peak if it's not there already. One thing we do note about this upswing, though, is that it's a little bit more fragile than what we saw through the COVID period. You can see that in terms of the monthly growth rate, it peaked in about May. Then when we got the June rate decision, that kind of dampened the momentum a little bit. And that's what we're expecting could happen from November if we get another uplift in the cash rate from the RBA. So this is also a measurement of the home value index over time, but what we've done here, because we produce a daily home value index, is create kind of a rolling monthly view. And that gives us a good idea of the kind of intra-month trend of what's going on. So, for example, these last data points are looking at the monthly change in the home value index, where the end of month is the 21st of October. So you can see how the property market has continued to perform through the course of this month. You can see that the growth rate across the capital city market and regional markets of Australia have been pretty steady over the past few weeks, with this rolling monthly growth rate of about 0.8% in our capital city markets. But when we look at that same daily index performance across the different capital cities and not just the combined capital city market, you see there's a little more diversity in some of these trends. At the moment, monthly growth ranges from a 0.5% uplift in Melbourne all the way up to 1.5% in Perth. And this is something we're going to see as we go through this presentation again and again, is that the fundamentals of supply and demand across Perth, Adelaide, and Brisbane all point to a continued uplift. Stock levels in those cities are really low, demand remains relatively high, migration for these for the broader states for these cities is very strong, which is contributing to that ongoing momentum in price growth. Sydney and Melbourne, conditions are a little more fragile, and there is, I think, risk of those markets actually dipping into a bit of decline if we get another rate hike in November. If we take a more detailed look at different housing markets across Australia, again, we see a great range in the level of capital growth over the past 12 months. So this table is showing you the top 30 performers of the SA4 subregions. SA4 is just breaking up the housing market into about 90 major sort of markets across Australia. And here we've got the 30 top performers by the 12-month capital growth rate. And what's an interesting trend with most of these areas is that, or at least the very top few, is that they are relatively affordable markets. I think given the credit constraints that come with a high interest rate, we're starting to see prospective buyers essentially trying to get more bang for their buck, or they're targeting markets where, it's a little more affordable under the high interest rate environment. So Mandurah in Perth comes out on top with a 15% growth rate in the past 12 months. You can see it's got a relatively low median dwelling value of about $550,000. Other relatively affordable markets at the top of the list include the Barossa York Mid-North region of South Australia, where values were up 11% over the past year. Baulkham Hills and Hawkesbury region of Sydney is obviously not a very cheap area, but what's happened over the course of 2023 as the market started to move back into upswing is that the high end of the market often leads those growth trends. So that's where you get a bit more of a mixed bag and some of the city markets in these top performers as well. But what you'll find about an area like the Baulkham Hills Hawkesbury region is that if you look at the more recent growth rate, say the past 3 months, that's actually started to come off the boil a little bit. But broadly, again, those more affordable markets are posting not only very strong 12-month growth rates, but many of them are at their peak. And they've got pretty strong 3-month growth rates as well. So of that 15% growth rate in the past 12 months for Mandurah, it's up 6% over the September quarter. So yeah, a lot of Perth, South Australia, again, Brisbane, some of those top areas as well, and a collection of relatively affordable markets. If we look at the other end of the spectrum, the kind of weakest performers over the past 12 months, these tend to be areas that were extremely popular during the pandemic period and saw very strong increases in demand from internal migration from capital cities to regions. So the Southern Highlands and Shoalhaven, Hobart, Ballarat, Bendigo, Geelong, Richmond, Tweed, these were all your big kind of lifestyle markets that saw a lot of popularity during the pandemic. In the past 12 months, the Southern Highlands and Shoalhaven has seen the biggest year-on-year decline at about 7%. What's interesting is that the values there are 14% below their peak, which was seen before interest rate rises in March 2022. You could see that as a potential risk for some of these markets. Maybe buyer interest is, if people are feeling risk averse, then they might want to stay away from a market that's in decline. But I think the other way to look at this is there's actually a real buying opportunity in these lifestyle markets that are sitting well below their peak values. What's interesting too is that if you look at the past 3 months for the Southern Highlands and Shoalhaven, it's up 0.5%. So it's starting to move back into recovery mode. In fact, if we look at many of the major regional centres that were extremely popular during the pandemic, we can see that quite a few of them are starting to come back into recovery mode after a short, sharp adjustment to rising interest rates. So these are some of the major regional centres across New South Wales, Victoria and Queensland as an example, and the rolling quarterly growth rates of these markets over time. Here you see the big COVID uplifts, those periods of decline. Now, most of these are back in upswing. Richmond Tweed just starting to kind of flatten out. So Geelong and Ballarat are the only of these markets that are still in decline. But even if you look at Geelong, for example, you can see the rate of decline is easing. So that signals to me that the worst of the downturn is past us, and we're probably going to see that decline shrink further and further until eventually the market stabilizes. But when you track that quarterly growth line and it starts moving up, even if values are still falling, it usually suggests that the market is close to reaching a trough. The opposite seems to be true of Ballarat, down 3% over the September quarter, and it looks like the momentum is still sort of going down. So, or the trajectory is still going down. So this looks like maybe it's not quite near a trough just yet. So that's the state of the regions. Broadly speaking, the recovery in regional Australia has not been as strong as what we've seen in capital cities. Over the past quarter, the September quarter, your capital city growth rate, the combined market, has been about 3% compared to about 1.5% in regional Australia. Now, sales volumes aren't as high as what we saw during the previous upswing. You can see these charts. We're looking at the rolling 3-month volume of sales. On the left-hand side is the capital city volume. On the right-hand side is the regional Australian sales volume. And the dotted line represents a historic 5-year average. So what you would usually see on sales volumes for a rolling 3-month basis. The combined capital cities market has seen about 78,000 transactions in the past 3 months, and that's around average. The historic average is about 73,000. And you can see that in the 3 months to September, the volume has kind of shrunk a little bit. We'll probably see a bit of a pickup through the spring selling season. But it's not like 2021, right, where you had this absolute frenzy of buying and selling activity. And annually in 2021, we saw a multi-decade high of 620,000 transactions. So how is it that your sales volumes aren't really picking up that much, especially in regional Australia? They're still below average, but prices are still rising. We put that down to relatively low supply still. It's starting to lift, and we'll look at that in a moment. But overall, the total level of listings across Australia is still lower than where you would usually expect it. And new listings coming onto the market, even though they're starting to rise, they're not as high as the volume of sales that we're seeing. So overall listings volumes are relatively low. Sales volumes are trending around their average levels in capital cities and a little bit below in regions. And again, it probably comes back to the fact that under such a high interest rate environment, not as many people can participate in the market right now. According to the banking regulator, APRA, the average serviceability assessment rate on a mortgage was 9% in the June quarter. So that's a very high level to be assessed at for repaying a loan, and it's probably constrained a lot of buyers in terms of finance as well. Okay, so this is the listings position. We're looking at the combined capital cities, and what this chart is showing us is a rolling count of new listings added to the market over the course of the year. And the blue line is what we've seen through 2023 so far. The dotted line, again, a historic average, and the orange line is 2022, so what we saw throughout last year. 2022, you can see we didn't get much of a spring selling season. We were still seeing a market decline, these consistently rising mortgage rates, and I think a lot of sellers were just very hesitant to put their property on the market. Through 2023, we've seen an unusual lift in new listings added to the market through winter, partly perhaps because we didn't have as much of a spring selling season last year and people were maybe playing a bit of catch up in terms of selling activity. There is perhaps some motivated selling happening as well, as people have had issues with mortgage serviceability. There might be people who are looking to sell properties before they fall behind on mortgage payments. So that could have something to do with the unusual winter lift in listings as well. And as we move into the spring selling season, over the past few weeks, we've continued to see those new listings added to the market increasing. This is the total listings position. So the previous graph of new listings is everything that freshly appears on the market over that 4-week period that we're measuring. This graph is showing you everything on the market, whether it's newly added or whether it's been sitting on the market for 3 or 4 months. So the total listings on the market across the combined capital cities is sitting at about 83,000, but usually you can see it's closer to 100,000. So again, this is why we believe that property values are continuing to rise. Even as more sellers come to market now, total inventory levels have a long way to go before they're servicing the amount of demand in the market or they're around kind of the historic levels that we're used to seeing. This is just the new listings graphs for the different capital cities. So you can see where that spring selling season is really kicking in now. Sydney, Melbourne, Canberra especially. There's a lot more sellers than coming onto the market now than what we would usually see. But you can see that new listings, and if we look at total listings, so again, this is the total inventory kind of graph, total supply on the market for sale is pretty much normalized around Sydney and Melbourne now. But if you look at Brisbane, Adelaide, and Perth, remember those are our markets that are still seeing really strong monthly growth rate. Listings volumes are still incredibly low. And again, as new properties are added to the market, they're selling quite quickly. The average selling time across Perth right now is 12 days. So there's still plenty of momentum in that market, and these markets look relatively undersupplied. If you look at markets like Hobart and Canberra, they're a little bit oversupplied relative to the amount of demand. And in fact, Hobart was the only capital city to still see a decline in September at 0.5%. I still really like Hobart. I think it's got good long-term fundamentals, and this decline we're seeing across the Hobart market is coming off the back of a very large, extended increase in property values throughout the 2010s, but it's definitely going through a kind of correction at the moment. So that's all I wanted to cover off in terms of capital growth, sales, and listings dynamics. I'm going to take us through a couple of other elements that are contributing to demand in the market. The first one is just looking at the investor segment. This was very much an owner-occupier-led upswing that we saw through the COVID period. But through the start of the year, we've started to see a little bit more strength in investor lending. There's been a bit of a structural change over the past few years where individual investors, I think, have struggled a little bit with rising mortgage payments. And CoreLogic data suggests that a higher than usual portion of new listings coming to the market were investment properties over the past few years. So this has led some people to, I guess, develop this narrative that there's been a bit of an investor sell-off. I don't know how how much of that is due to high mortgage rates or how much of that is due to the fact that there was just a lot of investment activity in the 2010s and maybe this is kind of natural turnover, but it has contributed to some volatility in the rental market, and that's generated more conversations around, well, are individual investors enough to provide for the rental market in Australia? So that's kicking off discussions around things like build to rent, more social and affordable housing. So that's just something, it's maybe not directly relevant to your day-to-day operations, but I think in terms of the broader operational environment for UrbanX, it's important to just be aware of that conversation is happening. Now, in terms of investor lending over time, that's what we see in the chart in the left-hand side here. So this is the monthly volume of lending that goes out for new property purchases. So for Australia-wide, that was sitting at about $7.5 billion in the month of August. You can see it's still well below the owner-occupier level of activity, but it's a faster growing segment through the start of the year. So since January, investor lending has increased 13% compared to a 5% uplift in owner-occupier borrowing. So that suggests that even though the investor segment is smaller than owner-occupier buyer segments, it's growing more rapidly at the moment. In terms of the total mortgage market, investors make up about 35%, which is pretty much in line with historic averages. This is the data I was talking to a little bit earlier, where we look at the portion of new listings added to the market in a given month that we think are investment properties. So historically, about a fifth of properties added to the market across the capital cities for sale are investments, similar proportions in regional Australia. In 2021, when capital growth conditions were really strong, I think there were some investors who looked to really cash in on the COVID boom, and the portion of new listings being added to the market that were investment properties surged to these peaks of 32% in capital cities and 35% in regional Australia. That portion of new listings that are investments remained fairly elevated. And again, I think that had something to do with rising mortgage rates and maybe some investors deciding, the numbers weren't stacking up for them in terms of cash flow. Even investors with a negative gearing strategy, and most Australian investors are negatively geared, but even those investors may have struggled with the differential between mortgage payments and rents over the past few years, which may have prompted more sales. And this has led to essentially a shrinking in the amount of total private rental stock that CoreLogic estimates is in the market. We think that over the past 6 months, rental stock has shrunk by about 100,000 properties. So this is just our count over time. So we estimate we're sitting at about 2.6 million rental properties across Australia, which is a little bit down from closer to 2.7. In terms of foreign investment, this is something that's been coming up a little bit in conversations with our clients and stakeholders because of, renewed international conflict and issues with the Chinese finance and property market. This is data from the Foreign Investment Review Board, which is quite lagged. It only goes back to June last year, and this is sales volumes per financial year and kind of a proxy for sales before that. But ultimately, the volume of foreign investment in total residential properties remains pretty low. NAB Bank does a great report, a quarterly housing survey, which has more current data on foreign investment interests in Australian property. And they track the share of foreign buyer interest in new and established properties. As you probably know, foreign investment into Australian real estate is generally veered towards new property. You can't really buy an established property as a foreign investment unless you're going to come here and actually live in the property. So it's mainly new property and off the plan where we see foreign investor interest. And that has actually risen quite substantially when we fast forward to the September quarter of this year. It's sitting at a 10% share of new property, and that's the highest level of foreign investment activity we've seen since 2018. So, whether the cause is international conflict or issues with the Chinese property market, or whether this is just the fact that Australian property is seen as a relatively safe and stable investment, the fact that property values are going up. I'm sure there are several different factors that contribute to that lift in foreign investor interest. I'll maybe take about 10 minutes just to go through some of the migration trends that are impacting the property market as well. There have been some pretty extreme fluctuations in migration, particularly overseas migration, which has in particular impacted rental markets, and down the line could have implications for the purchasing market as well. These charts are showing the position of overseas migration to Australia over time, and this data is updated to March of this year. So on the left-hand side, you have the net position of overseas migration. The net position of overseas migration is when you take your arrivals to the country from overseas minus your departures. And we can see that that net overseas position has reached record highs of 152,000 people coming to the country over the March quarter alone. Now, this is in part because arrivals to the country, so on the right-hand side chart here, the dark orange line, in the past year, we've seen almost 700,000 arrivals, and our departures were only about 225,000. So this really high net overseas migration position is a combination of record levels of overseas arrivals, but also fewer people leaving the country. And ultimately, that leads to more dwelling demand because all of those people need somewhere to live. This chart is showing that annual overseas migration position against sales volumes in Australia. There's not too much to this chart, but to say that there's no immediate direct relationship between overseas migration and sales volumes. 85% of overseas arrivals to Australia are renters when they first get here. So that's why we've seen so much additional pressure in our rental markets over the past year, particularly the capital cities where overseas migrants are more likely to settle. Some research from the ABS, which I've just copied a summary on the right-hand side here, basically points to the fact that it's not until quite a long time in Australia that migrants have a higher chance of home ownership. So the ABS points out that 38% of migrants who lived in Australia for less than 5 years owned their own home. 71% of migrants who lived in Australia for more than a decade owned their own home. So it's really more than 10 years that you would expect those overseas arrivals to be flowing through to purchases, which kind of makes sense because Australian housing is quite expensive and takes a long time to build up a deposit for both domestic and migrant buyers. Again, this is just looking at the relationship between rent growth and net overseas migration. So on the vertical axis here, you've got the amount of overseas migration that would be historically seen in small areas of Australia. And then along the horizontal axis is the value of rent growth since we opened up our borders in July last year. So it's a bit of a complicated chart, but it's just to say that the areas that are more likely to see overseas migration, areas like Parramatta in Sydney, Melbourne's western suburbs, the inner southwest of Sydney, those are the areas that have high exposure to overseas migration, and those are also the areas that have seen some of the strongest increase in rent values since we opened up borders last year. One of the benefits of a strong return in overseas migration is that we're also getting skilled labour back into the country. So this chart on the left-hand side shows the number of overseas arrivals to Australia in a given month that are on skilled visas. And in the month of August, that totaled about 71,000. The more skilled workers we have coming over, the more this helps with things like supporting our aging population, adding to economic activity, and notably adding to the construction sector as well. So on the right-hand side is the total number of people employed in building construction. That number is also rising. Western Australia has recently announced a $10,000 grant to bring residential construction work, all construction workers into the state. So this could start to divert more construction labour to the state. And I think that's going to be important to see how that plays out, because they obviously have a lot of residential properties that are still kind of stuck in the construction pipeline. This is migration trends by state. We've just put the 5 major states here, but this is also quite telling around some of the dynamics we're seeing in value growth as well. So on the left-hand side, you have the annual position of overseas migration to Australia. And again, you can see New South Wales and Victoria. Sydney and Melbourne account for about 2/3 of overseas arrivals to Australia. So it makes sense that the state numbers look very strong. But it's also notable that South Australia, Queensland, Western Australia, these states are also seeing levels of overseas migration that are pretty high relative to their pre-COVID levels. So even these smaller states are seeing a strong bounce back in migration that is sort of surpassing historic averages. This chart on the right-hand side helps to explain, again, some of the strong growth dynamics across Queensland, Western Australia, and South Australia. This is internal migration. So what this data tells us is that if your net internal migration is negative, it means more people are leaving the state to go to other parts of the country than are coming in. And what this graph tells us is that a lot of people are leaving New South Wales and Victoria in favour of Queensland, Western Australia, South Australia. Queensland has had a bonanza in the way of internal migration to the state. You can see that the pre-COVID levels were kind of subdued. And then during COVID, annual migration to Queensland peaked at about 50,000 people through 2021. Even though that's eased to about 31,000 over the past year, it's still really high relative to the history. So Queensland continues to see a lot of demand, not just from people coming from overseas, but there is still lots of people leaving the southern states to go to the Sunshine Coast, the Gold Coast, Logan, the Wide Bay region, continue to be very popular. One distinction that's important to make about internal migration is that the migration to regional Australia has really pulled back now. It's pretty normalized between capital cities and regions. So this chart is showing internal migration on an annual basis. This is quarterly. So in the March quarter of 2021, internal migration from capital cities to regional Australia hit this kind of peak through COVID, where everyone was fleeing the cities, looking for more space, looking for more affordable properties, looking for land. And migration to regional Australia peaked at about 12,000. Now that we're post-lockdowns, that's really pulled back. And in the March quarter of 2023, that migration level sat at about 6,000. So it's still positive. There's still more people leaving capital cities for regional Australia than coming in from regions to the capitals. But it's just kind of normalized back to what we were used to seeing in the tree change and sea change trend before COVID. Again, as a result, we think that this is leading to softer capital growth trends across the combined regional market. So I spoke to that earlier, and I won't go over that for time. Another interesting trend that we've picked up in our data is looking at short-term reselling. So this is the idea that for properties that are being listed on the market, we're looking at the portion of properties that were only held for about 3 years or less. The portion of these short held resales has really taken off across regional Australia, which suggests that some people might be selling off their properties. Maybe they made a COVID, tree change, sea change, and now they're changing their mind as they have to come back to work in office environments. Or it could be, again, people buying investment properties or short-term rental accommodation, and maybe they've made a lot of money, so they're selling it off in a relatively short period of time. Whatever the reason, it's clear that short-term reselling has been a more prominent trend across the country, but it's particularly prominent in regional Australia this year. So for August, or the year to August, we estimate that about a fifth of listings that were added to the market had only been held for about 3 years max. So that's a pretty wild trend to have observed this year as well. I might just quickly go through the mortgage rate piece, because this is something that has a big short-term influence on the housing market. Longer term, your housing market is going to be driven by basically supply and demand of property, population trends, and the completion of property. But mortgage rates have had quite a significant short-term impact just because of how drastic changes in mortgage rates have been as well. Oops, we've gone backwards. So this is looking at average mortgage rates over time by product type and whether it's an owner-occupier rate or an investor rate. But despite the borrower type or the product type, the low interest rate position that we saw through the 2021 period is long gone. We've gone from these average rates of 2 to 3% to about 5 to 7%. Interestingly, fixed rates are now a little bit lower than variable rates. So that suggests that the banks are maybe looking to lock people in at relatively high rates because they foresee interest rates coming down in 2024. But nonetheless, this is sort of limited the amount of buyers that can participate in the market at the moment. This chart is showing the average loan size across Australia over time. And again, you can see the impact of rising interest rates from mid-2022. But what's so interesting is that even though borrowing capacity is probably reduced about 30% with the serviceability buffer and rise in interest rates, the actual average loan size across Australia has only declined around 5%. The reason for that kind of disparity is that borrowers don't usually go to their maximum when they're getting a bank loan. So that's kind of put a buffer in, I guess, against how much the actual average value of loans has declined. The number of loans, however, has fallen more drastically. And again, this comes back to the idea that it's really higher income or people who are less reliant on credit, perhaps, who are still kind of participating in the market. This is reflected in APRA data. So our banking regulator produces these statistics around the portion of loans that go out on maybe more risky terms or more highly leveraged terms. So for example, mortgages going out with a debt to income ratio of 6 or more. So where your total debt levels represent more than 6 times your annual income. the portion of that kind of lending has gone from an extremely high level, almost a quarter of new loans in the December quarter of 2021, all the way down to just 6% in the June quarter of this year. So that reflects the increased serviceability buffer that was introduced at the end of 2021. It represents a lot more conservative lending and essentially less indebted borrowers that are buying homes right now. For recent buyers who maybe bought before the start of rate rises, this has had a big impact on their household balance sheet. So here I've done two hypothetical mortgage situations for a buyer in April of 2022, just before the start of the RBA cash rate hikes. And this one on the left-hand side is a full variable mortgage. On the right-hand side is assuming a 1-year fixed rate. Both are based on the average loan size at the time, and both are showing pretty exorbitant increases in monthly payments of mortgages. So for recent home buyers, there's a lot more pain going on right now. There's potentially a little more risk for these mortgage holders in terms of being able to fulfill their repayments. But yeah, it shows, I guess, the more extreme sticker shock that some households may have faced with these monthly mortgage repayments going up by more than $1,200 a month. So how have households coped with a rising mortgage rate environment? The first trend we're seeing is that households are saving less. So the national savings rate has gone down from a high of over 20% through COVID, all the way down to 3% in the June quarter of this year. There is some data to suggest that people are working more hours. So this index is showing the number of people employed over time versus the number of hours worked over time. And because the number of hours has risen faster than the number of people employed, it basically suggests that people are working more to try and get extra money to service their mortgages. And the other thing is that people are just putting less, again, like with the lower savings rate, people are putting less into offset and redraw accounts. So this chart is showing the total volume of mortgage payments that Australians make each month. The orange bars are your scheduled payments, so your principal and interest. The blue is your excess payments, so what goes into offset and redraw every month. And you can see that there's less going into the offset and redraw and more going into the interest payments, essentially. But amazingly, still positive. So Australians are still managing to save even through higher mortgage rates. This is just some analysis done by the RBA, which was pretty reassuring, basically showing that most mortgage holders are still in a positive equity position. Only 0.1% of home loans are estimated to be in negative equity through the recent downturn and rising mortgage rates. And arrears levels are very low. So currently, APRA is reporting the total amount of outstanding housing credit that's coming in late is just 1.3%. So just to finish up on the rental market, still a very tight market. Annual rent growth is sitting at about 8.5% nationally. This is down from a recent peak of 10% in 2021, but far above the historic annual growth rate we saw through the 2010s, which was an annual growth rate of 2%. Vacancy rates are still very low. They've actually reached fresh record lows as of September, sitting at 1% across the capital city markets. Again, that's where we're getting all of that overseas migration sort of flowing through, and 1.2% across the regions. I might just skip through to gross rent yields. These are starting to ease a little bit as the monthly pace of rent increases is slightly easing. Capital growth trends are coming back. But you can see that through the rental market upswing, gross rent yields have increased to kind of pre-COVID levels. So again, this is going to be potentially a more attractive piece for some investors. On the right-hand side, we have the different capital city gross rent yields, which range from around 6% across Darwin to Sydney and Melbourne, where gross rent yields have been closer to 2 to 3% over time. But for Sydney and Melbourne, I think the prospect is more capital growth than rent yields. So I did have a section on housing construction, but we're getting close to time and I'm conscious there might be some questions. So what I might do is just kind of skip through these slides to our summary, which is that there's a really thick mix of headwinds and tailwinds in place for the property market in the short term. There's even the threat of a further cash rate hike in the next couple of weeks in November. So short term, I think for Sydney and Melbourne in particular, there is some risk of the market going back into a mild downswing. On balance, there's a bit of an uncertain outlook, the downside from high interest rates, low consumer sentiment, uncertain economic activity. And so we might see a bit more heat come out of the recovery trend overall. But what I would say is long term, there is still very clearly a fundamental mismatch in the supply and demand of real estate in this country. And I think that bodes well for capital growth in 2024 and 5, when we're likely to see interest rates move lower. And that will hopefully come with higher sales volumes as well. So I might just pause it there and open it up for questions. But thanks for sticking with me. I know it's a lot of graphs. I've compiled the deck in PDF as well, so I can send that through for everyone to just sort of have a look at in their own time as well. But yeah, happy to take any questions now if we have them. I think Dan is on the line.
Hey, Eliza, I'm on.
Hey.
That was an amazing presentation. Well done. Great information.
Oh, thank you.
Great information.
Thanks very much.
And I think, one of the interesting statistics there is that the market is continuing to go up despite 12 rate rises. It's astonishing, really, and goes against what every economist has basically ever said. Warren Buffett says when rates go up, the heaviest items come down, which is obviously real estate being one, and yet it hasn't. Obviously, the statistics show that's driven by a shortage of stock still. Any thoughts or insights into, that changing? Because I guess, if that's what's holding the market together, an increase in stock, particularly a dramatic increase in stock, would likely smash prices by flooding the market. Any sort of thoughts or insights on that, Eliza?
Yeah, spot on, Dan. And I think that's the key metric that we're going to be looking at through the spring selling season. I think there is evidence of Sydney and Melbourne rising in terms of new listings added to the market. And that's why I think those are the markets that are more at risk of decline in value. That doesn't necessarily mean the market continues to get flooded with supply, because if prices start to come down, what we'll find is that sellers will tend to back off from the market again, unless they need to sell, which is where you get your, distressed sales, people falling behind on their mortgages. But even there, the RBA research suggests that not a lot of households are in that situation at all. So I think, there is some risk for Sydney, Melbourne. Other than that, I think the supply levels still look incredibly low. Even in the short term, with the Housing Accord's stretch goal of 1.2 million dwellings to be added to the market, I don't think that will really take off until 2026, 27, just because there are still so many constraints in the building industry.
Yeah, I would agree with that. They're talking about building a lot more properties, and you sort of struggle to see how they could do that. Hutchie's just came out recently and said that, they are getting smashed on profitability and they've got scale. If Hutchie's are getting smashed, what are the small guys doing? Hence why there's I think a historic level going broke as builders. So unlikely to kind of see a flood of new properties. Bill's asked a really great question. I was thinking something very similar around interest rates. I guess the two headwinds that we face are an increase in stock levels may have an impact. The second thing that may have an impact on the market is a 13th or even 14th rate rise. Likewise, Alexander Phillips recently came out and said that, as soon as they start dropping rates, the market's going to take off. And he's probably right about that. I think Westpac just came out and said that they see the next rate rises down, not up. I saw in your summary at the end there, it sort of said that there might be a few more increases, and the rhetoric is starting to increase around that for a Melbourne Cup rate rise. Any thoughts on rates or any insights from CoreLogic?
Yeah, so the key the key metric for an outlook on rates is going to be inflation.
Yep.
Inflation is moving lower. For September, there was a bit of an acceleration in the quarterly rate, but ultimately the annual rate is still down. Core inflation is coming down. It is moving in the right direction. I think it's just taking a lot longer than we thought it might. So hence there's some speculation around a November rate rise because your quarterly inflation figure accelerated a little bit. It was 1.2% for September, up from 0.8% in the previous quarter. And to be honest, international conflict, like what we're seeing in the Middle East, does pose an indirect inflationary risk as well. So that's the kind of thing that could see the cash rate move higher. However, I think from what we're seeing at the moment, broadly speaking, high interest rates are working to curb inflation. And that's where I could see the cash rate coming down probably towards the end of next year, second half of next year. Now, when that stimulates the property market, it's not reflected in inflation because established home values are not counted in inflation. So there's not too much risk of a re-acceleration of inflation from another housing market upswing. And that's where I think it could move higher, and we'd be more likely to get a robust upswing in 24, 25.
Bring it on.
Yeah.
Bring it on.
It's always a big upswing is always a reason to celebrate and certainly take advantage of it. The housing market always moves in cycles. So you do get those periods of uncertainty, falling sales volumes. But, I think long-term, the fundamentals are looking pretty good.
Nice. Okay, well, we've only got a couple of minutes left. Are there any other questions? Type them in now if you have any. Otherwise, we will wrap up shortly. But yeah, it's been really great and some great information going into spring. As I've written in the chat, I think one of the most compelling stats there is that 1/5 of people that have bought in the last 3 years are putting their properties back on the market. For most areas, the average length of ownership is 7 to 10 years. And so I just kind of wanted to reiterate my note in the chat, which is I'd be doing a marketing campaign around that. There will be people that are looking for, it might be investors that have purchased during COVID and now want to get out. I remember looking at properties during COVID and sort of thinking, geez, the rent's going to cover it and I'm going to pick it up for free. And now that's no longer the case. Two, I think a lot of people move to regional areas, with this work from home trend that started through COVID, that's pulling back in a major way. So people might be moving back. And Eliza, I don't know if you've got any information on it, but I saw an interesting stat the other day that said the Sunshine Coast is getting quite smashed at the moment, which I thought was really interesting because that was like one of the biggest markets that grew through COVID.
Yes, so Sunshine Coast and Gold Coast are both back in upswing now.
Yeah.
Just looking at the market value. So Sunshine Coast was up 2.4% in the September quarter. Gold Coast was up 3%. And that's despite the fact that both of these markets are sitting about 50% higher in value since the onset of the pandemic.
Wow.
So yeah, I've also heard anecdotes that it's getting very hard to buy on the Gold Coast. So really good selling conditions for those that are interested in selling there.
Nice. Awesome. Well, Eliza, that's been fantastic. On behalf of everyone, thank you so much for your time today. We really appreciate it.
Thanks so much for having me, and have a great weekend, everyone.
Oh, well, a while to go yet, but looking forward to it.
I'm hopeful. I'm like, we're nearly there. Who's counting? All right.
Thank you so much. Thank
Thanks,
you.
everyone.
Thanks, guys.
Bye.